Let me ask you something right now. When silver hit a record high of $121 per ounce on January 29th of this year, were you watching? When it then crashed nearly 50% in a matter of days and briefly erased all of its gains, did you panic and sell? Or were you the person who stayed calm, studied the chart, and asked the more important question: what is actually driving this metal right now, and where is it going next? Because if you are someone who tracks gold and silver prices daily, who watches every dip and every spike, who felt something shift in the precious metals market over the past 12 months, then you are exactly who this video is for. And if you have not subscribed to this channel yet, hit that subscribe button right now and press the bell icon so you never miss a market update like this one, because what we are about to break down could change how you position your portfolio for the rest of this decade. Now, let us talk about what is actually happening in the silver market, because the story is far more complex and far more significant than most headlines are telling you. Silver started 2025 at $29.29 per ounce. By January 29th of this year, it had hit an all-time record of $121 per ounce. That is a gain of over 313% in under 13 months. Let that number sit with you for a moment. 313%. In less than 14 months. If you had put $10,000 into silver at the start of 2025, you would have been looking at over $41,000 at that peak. That is not a stock tip. That is not hype. That is simply what happened in the market. But here is where it gets interesting, and here is where most people made the wrong decision. After that record high, silver entered what analysts are calling a historic liquidation. The CME Group raised margin requirements on silver futures contracts, forcing traders without sufficient capital to close their positions or face automatic liquidation. In a matter of days, silver dropped from $121 down toward the mid-$70 range, erasing nearly half of its value in a compressed window of time. The 14-day RSI had been sitting above 70 for weeks, a classic overbought signal that technical traders know well. And yet, within days of that correction, silver began recovering. By February 9th and 10th of this year, silver had jumped over 6% toward $83 per ounce, extending a powerful rebound. So the question every serious silver investor needs to sit with right now is this: was that crash a structural breakdown, or was it a market mechanism shaking out weak hands before the next leg higher? If you want to understand the answer, you have to look at the fundamentals, not the noise. And the fundamentals of silver right now are unlike anything this market has seen in a generation. Let us start with industrial demand, because this is the piece of the silver story that most gold-focused investors still underestimate. Silver is not just a monetary metal, it is an industrial one. And the industrial demand story for silver is accelerating in ways that are structural, meaning they are not going to reverse quickly, even if the economy slows. Industrial applications now account for over half of total global silver demand for the second consecutive year. Solar panel usage alone rose more than 25% in 2024, with newer photovoltaic technologies requiring up to 50% more silver per panel than earlier generations. By 2050, cumulative solar energy demand could consume 85 to 98% of today's known silver reserves. That is not a forecast from a silver bug with a newsletter. That is a structural supply-demand gap that is already showing up in the data. EV-related silver demand jumped an estimated 20% in 2025. As vehicles become more electric and software-driven, silver intensity per vehicle continues to rise due to sensors, high-voltage wiring, advanced connectors, and power management systems. And here is a demand driver almost no one was talking about 2 years ago: AI infrastructure and data centers. These facilities use silver in high-efficiency electrical components, precision contacts, and thermal management systems built to handle extreme power loads. Every server rack, every cooling system, every power distribution unit in a data center has silver in it. And we are building data centers at a pace the world has never seen before. Now layer on top of that the supply side of the equation, because this is where the structural story becomes genuinely alarming for anyone who understands how commodity markets work over long time horizons. 2025 marked the 5th consecutive year of a global silver supply deficit. Mining output is not keeping pace with demand. The biggest silver-producing countries, Mexico, Peru, China, Australia, Chile, Bolivia, the United States, Poland, and Russia, are not bringing new supply online fast enough to close the gap. Mining is a slow business. You cannot turn on a new silver mine in 12 months. Exploration, permitting, construction, and production ramp-up take years. That means the structural deficits that has been building for 5 straight years is not going to be resolved quickly. And shrinking inventories are beginning to show up in the price action in ways that cannot be explained by speculation alone. Now let us bring in the macroeconomic layer, because silver does not trade in a vacuum. It trades in the context of monetary policy, currency strength, geopolitical tension, and global risk sentiment. And right now, all of those forces are pointing in the same direction. The US dollar has been under pressure. The US presidential administration hinted at efforts to weaken the dollar earlier this year, which sent precious metals surging. 1 year ahead, US inflation expectations fell to 3.1% recently. But longer-term inflation fears remain deeply embedded in investor psychology. The Federal Reserve is under pressure. The nomination of Kevin Warsh for the next Fed chairman, who has historically held strong views against an expansionary Fed balance sheet, created a brief headwind for precious metals, contributing to the January correction. But that headwind is not permanent. Markets are already beginning to price in potential Fed easing later this year as inflation expectations soften and labor market data comes in mixed. Real yields, the inflation-adjusted return on holding cash or bonds, are one of the most powerful drivers of gold and silver prices. When real yields fall, the opportunity cost of holding silver goes down, and capital flows into hard assets. That mechanism is reasserting itself right now. In Japan, a landslide election victory for Prime Minister Sanae Takaichi's ruling coalition strengthened expectations for expansionary fiscal policy, further supporting demand for hard assets like silver globally. Geopolitical tension between NATO members, uncertainty in the Middle East, and ongoing US-Iran nuclear talks are all feeding into the safe haven bid for precious metals. These are not temporary headline risks. These are structural geopolitical tensions that are not going to resolve themselves in a quarter. And through all of this, silver continues to play its dual role: monetary safe haven and indispensable industrial input. That dual identity is what makes silver uniquely positioned in this environment. When you buy gold, you're primarily buying a monetary hedge. When you buy silver, you're buying both a monetary hedge and an industrial growth story. That asymmetry in the risk-return profile is something institutional capital has been waking up to over the past 24 months. On January 26th of this year, the iShares Silver Trust ETF saw a turnover of nearly $40 billion in a single session, according to Bloomberg. That is a figure comparable to the SPDR S&P 500 ETF, the largest and most liquid equity ETF in the world. That is roughly 20 times higher than the silver ETF had been averaging for most of the prior year. That kind of volume tells you something important. Institutional and retail capital is flowing into silver in volumes that were essentially unimaginable 18 months ago. Now, let us talk about where analysts are placing their price targets, because this is where the range of outcomes is genuinely wide, and where you need to understand the difference between the consensus and the outlier forecasts. At the conservative end, Bank of America has upgraded its 2026 silver outlook and now predicts silver will reach $65 next year with an average price of $56.25. UBS has lifted its silver price prediction for mid-2026 to $55, up from $47 previously, citing ETF inflows and fiscal imbalances. These are the large, cautious institutional forecasts, built on the assumption that the January spike was an anomaly and that prices will cool toward a more sustainable range. But here is what is interesting about those forecasts. At the beginning of 2025, the London Bullion Market Association polled analysts and received an average silver price forecast of $32.86 for the year. Silver ended 2025 above $72 per ounce, which is a 147% gain from the start of the year, and more than double what the consensus expected. That means the institutional forecasters were not just wrong, they were directionally wrong by a significant magnitude. At the more aggressive end of the forecast spectrum, Felipe Gezels at BNP Paribas has predicted silver could reach $100 per ounce by the end of 2026. Allegiance Gold strategists have issued a near-term silver price forecast of between $100 and $144 per troy ounce. Gold Silver's lead analyst Alan Hibbard has stated he would not be surprised to see silver increase by over $100 per ounce from recent levels, targeting $175 or higher in 2026. Some technical forecasters are placing the end of 2026 price at $106.80 tau, with projections running toward $160 by December of that year. And Robert Kiyosaki, the author of Rich Dad, Poor Dad, has publicly predicted silver reaching $200 by 2026. Ned Naylor-Leyland at JAM told CNBC earlier this year that investors should assume silver will break through triple digits in 2026. Now, I'm not asking you to take any single forecast as a certainty. Anyone who tells you they know exactly where silver is going is not giving you analysis. They are selling you certainty they do not have. What I am telling you is this. The range of outcomes for silver over the next 12 to 24 months is skewed asymmetrically to the upside. The downside scenario, where silver falls back to $40 or $30, requires a rapid resolution of geopolitical tensions, a dramatic reversal of industrial demand growth, collapse in solar and EV deployment, a sudden surge in mining supply, and a hawkish Federal Reserve willing to hold real yields elevated for years. That scenario is possible, but it requires multiple things to go wrong simultaneously. The upside scenario, where silver moves through $100 and toward $150 or beyond, requires only that the current structural trends continue: ongoing supply deficits, sustained industrial demand, continued monetary uncertainty, and investor reallocation toward hard assets. That scenario requires fewer simultaneous conditions to hold. That asymmetry is what rational capital allocators call a favorable risk-adjusted return profile. Now let us talk about the gold-silver ratio, because if you track these markets daily, this is one of the most important indicators you have access to, and it is telling a very specific story right now. Historically, the gold-silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, has averaged somewhere between 40 and 60 over long periods. In recent years, it ran as high as 120 during the COVID panic of 2020. Even after silver's massive 2025 run, the ratio is still elevated relative to historical norms, which tells you one of two things. Either gold is overpriced, or silver is not yet fully repriced to reflect the current monetary environment and industrial demand reality. Given everything we have discussed about silver's structural demand picture, the more logical interpretation is the second one. Silver is still playing catch-up to gold's monetary repricing, while simultaneously being repriced for its industrial value. Those two forces compounding together is what creates the structural case for silver outperforming gold on a percentage basis over the next several years. And here's the practical implication of that. If the gold-silver ratio simply normalizes toward 50 from its current elevated level, and if gold holds its current price, silver would need to significantly increase from where it is trading right now just to reach ratio parity. That is not a speculative argument. That is a mathematical relationship embedded in decades of market history. Now, let us be honest about the risks, because a serious conversation about silver cannot ignore them. The January 2026 correction was a reminder that silver is not a smooth ride. It is one of the most volatile assets in any market, precious metals or otherwise. The Hunt brothers tried to corner the silver market in 1980, driving prices from $6 per ounce to nearly $50. The market collapsed after the COMEX implemented Silver Rule 7, restricting margin buying. Within 2 years, silver had lost 90% of its value. In 2011, silver again ran toward $50 on a weak dollar and surging demand. Exchanges hiked margin requirements, the speculative bubble burst, and prices fell sharply. History does not repeat exactly, but the mechanism of margin-driven liquidation cascades is real, and it can happen quickly. The January 2026 correction followed exactly this pattern. Record prices, overbought technical conditions, margin requirement hikes by CME Group, and forced liquidations that amplified the downside move. For short-term traders, this volatility is the risk you are managing every day. For long-term investors building a position over months or years, this kind of correction is a feature, not a bug. It creates entry points at lower prices within a structurally bullish long-term trend. The question for you is, which kind of silver participant are you? If you are a long-term investor with a 3 to 10-year time horizon, the structural case for silver is intact. Supply deficits do not resolve in a quarter. Industrial demand from solar, EVs, and data centers is not going to reverse. Monetary uncertainty is not going to disappear. If you are a tactical trader, the current environment demands discipline, strict position sizing, and a clear stop-loss framework, because the volatility in silver right now is institutional grade. And if you are neither yet, if you are just beginning to understand why silver deserves a place in a thoughtful portfolio, the most important thing you can do right now is educate yourself on the fundamentals before you put capital to work. Dollar cost averaging, buying at regular intervals regardless of short-term price swings, is the most reliable way to build a silver position for most investors. It removes the psychological burden of trying to time the bottom and allows the long-term structural thesis to compound in your favor over time. Conservative allocation guidance from most precious metals, analysts places silver at 2 to 5% of total portfolio assets, alongside a gold position. Moderate investors often target 5 to 10%, balancing growth potential and inflation protection. These are not hard rules. They are frameworks for thinking about sizing within the context of your overall financial position. What is clear from the data is this: silver in 2025 delivered a 147% return, making it one of the top performing assets across any class in that calendar year. Gold delivered 64% in the same period. Both outperformed equities, bonds, real estate, and most alternative assets. And the structural drivers that produced those returns are still in place. The deficit is still there. The industrial demand is still accelerating. The monetary uncertainty is still present. The question is not whether those forces matter. The question is whether you have a clear framework for how to participate in this market in a way that aligns with your own risk tolerance, time horizon, and financial position. That is the conversation worth having. Not whether silver will hit $100, not whether it will correct again. but what your personal relationship with this asset class looks like, and whether it is serving your long-term financial trajectory. Because ultimately, the investors who benefit most from a move like silver's 2025 run are not the ones who caught the exact bottom. They are the ones who understood the structural story early, sized their position appropriately, and held through the volatility with conviction rooted in real analysis. That is the edge that comes from doing the work. And that is exactly what we try to give you on this channel every single time we publish. If this video helped you understand the silver market more clearly, I want to hear from you in the comments below. What is your current view on silver? Are you holding, buying the dip, or waiting for more clarity before you make a move? Do you have questions about the gold-silver ratio, the supply deficit data, or how to think about position sizing in a volatile precious metals environment? Drop your questions and your perspective in the comments, and I will respond to as many as I can. And if you have not already, please subscribe to this channel and hit the bell icon so you get notified every time we publish new market analysis like this. Hit the like button if this video gave you real value, because it helps more serious investors like you find this content. We will see you in the next one.